Good morning, everyone. Welcome to our live daily market outlook for Monday, 3rd of September, 3rd of October 2011. It's the beginning of month and the beginning of the last quarter of the year with the current market sentiment and the overall picture of the world's economy is, I would say, being quite dark, as immediate result of the latest news from Greece was the fresh weakness of the single currency. The black clouds are again coming above the Greece, as most likely the Greece will miss deficit target set just months ago in a massive bailout package, according to the government's draft budget figures released yesterday, showing that drastic steps taken to avert bankruptcy might not be enough. The dire forecast came while inspectors from the International Monetary Fund, Eurozone and European Central Bank, known as Troika, they were in Athens scoring the country's books to decide whether to approve a loan tranche or not. Without that installment, Greece would run out of cash as soon as this month. The draft budget for 2002, approved by Cabinet yesterday, predicts a deficit of 8.5% on GDP for 2011, and it's already well short of the 7.6% target. The 2012 deficit is set to meet a nominal target of 14.6 billion euros. But at 6.8% of GDP, it falls short of a target of 6.5% because the economy will shrink further. Now the European officials are scrambling to avert an abrupt Greek bankruptcy, which would wreck the balance sheet of European banks, jeopardize the future of the single currency, and potentially plunge the world into a new global financial crisis. So, as I mentioned in our earlier sessions, no signs of improvement in the Greek problem. On contrary, the problems are deepening. Now, we are going to see what the Eurozone officials will do this time, because this is a critical question, the critical moment, not just for Greece, it's for existence of whole idea of Eurozone, of single currencies, because in case of failure of Greece, then most likely the chain reaction would hit the other countries, especially the first to come, Italy, Spain, Portugal and Ireland. And most likely this would be the end of the European Union itself. The markets were quite active during the Asian session, as based on this, I would say, bad news from Greece. The euro extended losses, hitting fresh 8-month low. Sterling was also lower against the US dollar. Dollar is strengthening across the board, with the dollar yen having a renewed attempt to emerge out of nearly 2 months range after initial attempt started on Friday, and the overnight's break. Friday's closing above 77 mark, and the overnight's break higher, looking for a breakout of the recent range and establishing a new trend. The dollar Swiss is back to strength after ending the correction from 91.80 high, with the 89.20 giving a good support for now. Gold is back to strength also, as idea of safe haven instrument that was sort of abandoned in the past couple of days. Actually, the investors are likely back into gold and bringing the yellow metal higher. Now we'll take a look on the technical outlook into details, and the crude oil is again in the strong downtrend and is approaching actually the previous low of $77.12 per barrel posted on just a week ago. So let's first take a look on the let's first actually take a look on the today's calendar. Australia and China are having the bank holidays today. Also, the Germany. The important releases that are due today are PMIs from Eurozone. First from Eurozone that comes at actually I think it's already out. Let's just to check it. Just okay, the manufacturing PMI from Eurozone came out slightly better than expected. 48.5 was the release a couple of minutes ago versus 48.4, the forecast and the previous release. The next to come in approximately 15 minutes is manufacturing PMI from United Kingdom. 48.9 is consensus for today, and previous release is 49. And then later in the afternoon from US ISM manufacturing PMI forecast slightly below the previous release of 50.6. For today 50.5. Also from US construction spending expected to decrease minus 0.1% versus previous worse than forecast minus 1.3% of the previous release. And both are due at 1400 GMT. Now let's take a look on the instruments and see what are the technical outlooks for today. Starting with euro, as we can see on the 4-hour chart, the euro maintains its broader downtrend that is from 145.48, 29th of August high, with the recent gains being capped at level just under 137, where was also the main trend line coming, and the loss on the downside of 135 support zone and the further extension down below 134 ended the last week at 133.90. This was the this was the Friday's closing, ahead of gap lower opening overnight. Opening price was 133.43, and the pair dipped down to 133.12, just ahead of psychological 133 support. And the outlook remains negative for euro. So we lost some key supports such as 133.32, which is 6 August 2010 high, and approaching now 133, below which opens 132.43, which is the low of 16th of January 2011, and 130 as a psychological and figure support comes in sight in case of break lower. At this point, we have a corrective bounce on the oversold hourly studies, and also the other studies were quite extended. So we are looking for test of initial resistance which comes around 133.60, where also falls the 20 days moving average on hourly chart, currently at 133.74. I would say the filling this gap would be the likely scenario, as the upper boundary is at 133.83. Basically, reversal under 134.50-60, which is this higher low here, is expected to maintain the recent bearish tone and resume lower. At this point, only break above 134.60 would delay immediate bears and allow for some stronger recovery. On the Fibonacci, we have this, you can see that this is just above 38.2 retracement of the broader downtrend from 136.77 down to 133.12. So lower top is expected to occur somewhere under 134.60 in order to keep this immediate bear tone in play. Otherwise, we might see extension higher towards 50% Fibonacci, which is at 130, close to 135. And then the next level is 135.20, previous support now reverted to resistance. The studies, as I said, are still quite supportive of further weakness. However, the current bounce is seen corrective ahead of fresh push lower, and previously mentioned levels 132.43 comes next with a possible extension to 133 not ruled out at in the short term. The British pound against dollar extended the recent bear trend from 157 zone after correction from the low of 153.26 posted on 22nd of September. The gains were initially capped just under 57 barrier, and this is actually capping upside at the moment. With the loss of 155, 40, 30, which are the 29th and 30th September lows, extending and also losing the psychological support of 155, extended the losses down to 154.90 so far, where the bounce emerged on oversold hourly conditions. On the upside, initial resistance comes at, actually the initial was at 155.30 already cleared. The next level comes around 55.80, 156.00, where the reversal is expected in order to keep the immediate bears in play. Hourly 20 days moving average currently at 155.72 coming under pressure. However, reversal under 156.64, which is the previous high and the lower top of the movement down from 157.14, would keep the immediate near-term bears in play and will keep them intact for a fresh push lower. Below 154.90, we will be looking for a 154.00 as a round figure, and possible test of the key support at 153.26, which is the 22nd of September low, and this will signal the extension of the broader downtrend of cable from 166.17. And below the later opens 150, we have 150, pardon, comes to 152 and 151.50 ahead of possible further extension that we'll see on the longer term outlook. Actually, it is here. The long-term ascent from 142.30 low of 2010 posted in on 16th of May 2010. We can see that the recent reversal has so far retraced over 50% of this move, losing also the key support at 153.43, 153.26, so briefly below this one. Increasing fears of further extension lower, and looking for test of 61.8%, which is around 151.89 at this point. However, the studies are firmly bearish. We can see in the daily that a golden cross has, death cross, pardon, has occurred here, where the 20-day average crossed below 200 days also 55 and 9 crossing lower. This keeps the firm bear trend for intact for further extension lower. On dollar yen, there was a sort of improvement from Friday's, actually last week's rally that started from 76.50 zone and extended above 77 to hit 77.25 high overnight. This is the high of the day. It's also significant that closing above 77 on Friday, just marginally above the 77 level, which is our key barrier at this point, keeps now the sort of positive tone. However, the market already reversed under 77. Initially, the gains were held just at 77 zone. Recent extension down to 76, 75, I would say, turns the near-term tone again into the negative fields as the break below 20 days, hourly 20 days moving average now keeps pressure on the pair for further extension lower. The only positive result would be break above 77, 77.25. That would keep immediate bull action from 76.50 and look for test upside at 77.85 and 78.00 as initial targets. Holding below 77 brings the pair back to the recent 7 weeks directionless range trading and keep the 76.30, 77 range again intact as a number of we can see a number of unsuccessful attempts to clear 77 occurred. This is the second one from 15th of September for in past nearly 3 weeks that managed to break above 77, while downside remains supported at 76.10. The recent lows ahead of 76 and 75.93 record low, below which would be very bearish. At this point, I would say the immediate tone is again turning negative, and only regain above 77 and 77.25 would improve the current outlook. Dollar Swiss reversal from 91.80 high of 22nd of September, lost initial support at 90.00 and extended losses to 89.20, the zone of the previous high that was posted on 12th of September, where the good support was found and the fresh rally underway. Gap higher opening today supports current strength with the 91.27 seen so far, just ahead of a lower high at 91.41 from 26th of September. With current correction pullback on the overbought hourly conditions, seeing just corrective and initial support at 90.80. Around 90.80 zone, where also comes the hourly 20 days moving average. However, the broader picture remains quite positive and supportive for the dollar Swiss, and the immediate targets are on break of 91.41 comes 91.80 and 92.00. Also, the significant point here is again the golden cross of 20 days moving average crossing above 200 days moving average that maintains the current positive and bullish structure, and the target remains, as I mentioned, 91.80, 92.00 initially. Above here comes 93.38, the next level. From the commodities, the gold is, as I mentioned, back to strength. As we can see, from the wave patterns, we have the 1, 2, 3, 4, 5, and then we have A, B, and the leg C is now underway. Should be equivalent to the leg A, and they should regain the 1675, which is the high of 27th of September, which is also our strong resistance. And basically break above here is required to confirm the near-term bottom at 1532 and open way for a stronger recovery of the gold, as the reversal from 1920, the record high, significantly fell, losing some nearly $400 and ending down at 1532 on 26th of September. So basically the outlook, the near-term outlook is quite supportive, and the regain of 1675 is at this point it's a key level for breaking higher. Also on the daily chart we have initially we have 90 days moving average to be cleared ahead of 1675, and this would open way for a stronger recovery of the gold. However, the longer term outlook remains still bullish, as the strong support was found just above 200 days moving average that currently stands at 1532, where the losses were contained on reversal from 1920 record high, pardon. Crude oil, again, recovery from 77.12, 26th of September low, has peaked at 84.75, and the fresh weakness, renewed attempt higher again was failure, and the fresh weakness extended now to 77.35. So we are just a few ticks of full retracement of this correction, and most likely extension lower, as the broader downtrend remains intact from 114.80 with series of lower highs, and the trend line drawn from the peak, maintaining and defining the current downtrend. Loss of 77.12 would open way for a fresh bear phase with the 73 zone coming into focus, and then 70 zone seen next as a part of the broader reversal of the uptrend from higher platform at 67.15, or on the bigger picture from 35.11 low of 2008. It's the post big rally that ended up close to $150 per barrel, pardon, and then dropped down to 35. So at this point on the longer term we can see the reversal that nearly retraced nearly 50% of the move from 35.11 up to 114.80. So the level that comes as a strong support at this point is around 74.60, with 50% retracement of the broader uptrend. So 77.12 on the downside and 74.60 are our initial key levels, ahead of 73 and 70 zone. That would be the next targets in case of break below 77.12. On the upside, initial resistance comes as on low of 29th of September, which is 79.63. However, the break above 81.41, where is the currently 20 days moving average. Actually, the 20 days moving average is currently maintaining this negative tone, and break here and regain of 83, minimum 83 level is required to improve the outlook. However, the clearance of 84.75 is needed to resume higher, but for the time being the very negative outlook for crude oil keeps downside favored, with test of 77.12 seen as a likely scenario in the short term.